Every single investor, whether you're just starting out or you've been doing this for years, you face the exact same question. Where do I put my money? Well, the answer almost always comes down to two very different paths that are really the bedrock of all of finance: equity and fixed income. And trust me, understanding the difference is the first big step toward building real wealth.
I want you to think about your financial journey like you're planning a hike. Are you aiming for that incredible mountain peak? The one with the breathtaking views, but also some pretty challenging, volatile terrain? That's the path of growth. Or are you looking for a nice, steady, paved road that pretty much guarantees you reach your destination safely? That's the path of stability. The choice you make here really defines your entire investing strategy.
So here's our roadmap for this explainer. First, we're going to define these two core paths. Then we'll dive deep into the world of equity and then the world of fixed income. After that, we'll put them side by side, look at a modern tool that kind of bridges the gap, and finally, talk about how you can build a portfolio that's just right for you. All right, so let's get right back to that crossroads. These two paths, equity and fixed income, they aren't just some abstract financial concepts. They represent the two main ways that capital is raised and grown in the entire global economy. Getting a handle on them is absolutely step one to becoming a savvy investor. Okay, let's start with that first path, the challenging but oh so rewarding mountain trail. This is the world of equity. This is the path you take when your number one goal is growth. You're looking to really grow your capital over the long haul. So, what even is an equity investment? Well, to put it simply, when you buy a stock, you're buying a tiny piece of that company. You literally become a part owner. So if the company does well, the value of your piece, your stock, goes up. You're getting to share in the potential success and the growth of that business. Now, this path highlights a classic trade-off. With equity, you get higher potential returns, for sure, but that comes with higher risk and a lot more volatility. Prices can swing wildly. The main goal here is capital appreciation, and a really key point is just how accessible it is now. Things like low-cost brokers and fractional shares have really opened up these markets to pretty much everyone. Okay, let's leave that mountain peak for a bit and walk over to the other path. This is the world of fixed income, that steady, paved road. This path is way less about explosive growth and way more about protecting your capital and generating a predictable stream of income. Now, this is completely different from buying a piece of a company. A fixed income investment is more like you becoming the bank. You are loaning your money to a government or a corporation, and in return for that loan, they promise to pay you regular interest over a set period of time, and then, at the very end, give you your original investment back. That's the principle. The characteristics here are pretty much a mirror image of equities. In exchange for taking on lower risk, you have to accept lower potential returns. The main goals are just preserving your initial investment and generating that steady income. And, historically, it was a lot harder for individual investors to get into these markets, but that has changed a lot. So we've explored both trails. Now let's get that bird's eye view, because when you see them side by side, that's when the differences become crystal clear. Okay, let's break this down. With equity, you buy a stock, which is ownership. With fixed income, you buy a bond, which is debt. It's a loan. The risk profiles are complete opposites. Equity is higher risk for higher potential return, while fixed income is lower risk for lower returns. Equity's goal is growth. Fixed income is all about preservation and income. And finally, access has been a huge differentiator, with stocks traditionally being much, much easier for everyday people to buy directly. But what if you didn't have to choose just one path? What if there was a way to build a bridge between that mountain trail and the paved road, letting you travel both at the exact same time? Well, in modern investing, there is. Remember how we just said that bond markets were historically tough for individuals to get into? Yeah, buying individual bonds could be super complicated and expensive. This created a huge barrier, which made it really difficult for everyday investors to build a truly balanced portfolio. And that's where the ETF, or Exchange Traded Fund, comes in. Think of an ETF like a shopping basket. Instead of going out and buying just one apple or one orange, you can buy one basket that's already filled with hundreds of different stocks or bonds. And the best part? That whole basket trades on a stock exchange just as easily as buying a single share of a company. ETFs were a total game changer. They bundle all these assets together, they let you trade that whole bundle with a single click, and they give you instant diversification. This really blurs the lines between the equity and fixed income worlds. A lot of their power comes from being really low cost.
usually because they just passively track an index instead of paying some fund manager to try and pick winners. So now you can buy one ETF that tracks the entire stock market, or another one that holds thousands of different bonds, like a mix of US Treasuries and high-quality corporate debt.
And all of this brings us to the ultimate goal. See, the question isn't, should I pick equity or fixed income? The real question is, what's the right mix of equity and fixed income for me? The real power comes from using these tools together. Think of it like this. Equities are the engine for your long-term growth. Fixed income provides the stability and income to smooth out the ride. And ETFs, well, they give you an easy, accessible way to build that combination, creating a portfolio that balances all of your needs.
At the end of the day, there is no single right answer. Your personal mix of that mountain trail and that paved road, well, that's going to depend on your age, your goals, and your own comfort with risk. But by understanding these two fundamental paths, you now have the map. So the only question left is, what course are you going to chart?